Have you ever felt like the stock market is a chaotic roller coaster you're too scared to ride? Oil prices crashing, tech stocks tumbling, travel industries in free fall. Opportunities like this don't come around often. But here's the thing. While others panic, smart investors thrive. What if I told you that recessions and market crashes could be your golden ticket to financial freedom? But only if you avoid these common pitfalls. In this video, I'll break down the 6 biggest mistakes beginners make and how to steer clear of them. And make sure you stick around till the end. I'll share 2 powerful stories of people who overcame these mistakes, one from the United States and one from Singapore. Before we dive in, hit that like button and subscribe to Wealth for You. It helps the YouTube algorithm show this video to more people, and it might just change someone's financial future. Let's get started. Mistake number 1. Not investing at all. The biggest mistake isn't a bad investment. It's not investing at all. Keeping your money in the bank might feel safe, but inflation quietly erodes its value year after year. It's like leaving your wallet in the sun and watching it shrink without realizing it. Think about this. Over the next 30 years, inflation could cut your savings purchasing power in half. Imagine needing double the money just to buy the same things when you're older. So, here's the big question. Are you truly saving for the future, or just watching your hard-earned money lose value? Saving alone isn't enough. You need to save and invest to grow your wealth faster than inflation can eat it up. Mistake number 2. Not having an emergency fund. Before diving into investing, you need a solid foundation. And that's your emergency fund. Think of it as your financial safety net, ready to catch you when life throws curveballs like unexpected bills, job loss, or yes, even a global pandemic. Without this cushion, you risk being forced to sell investments at a loss during tough times, setting back your financial progress. Here's a quick check. Do you have at least 3 to 6 months of living expenses saved up? If not, start small. Even $1,000 can make a difference, and build from there. Your investments will thank you for it. Mistake number 3. Trying to time the market. Here's a tough truth. There's no such thing as the perfect time to invest. Markets go up, down, and sideways, and waiting for the right moment often means missing the best opportunities. Trying to time the market, whether it's buying at the lowest low or selling at the peak, isn't just hard. It's nearly impossible. Even the pros rarely get it right. Instead of stressing over timing, focus on time in the market, not timing the market. A smart way to do this is through dollar-cost averaging, investing a fixed amount regularly, no matter what the market is doing. This approach takes the guesswork out, reduces emotional decision-making, and lets compounding work its magic. So, what's holding you back from starting today? Let me know in the comments. I'd love to help you take that first step. Mistake number 4. Chasing hot tips. We've all been there. A friend, social media influencer, or even a well-meaning relative says, "This stock is going to the moon." It's tempting to jump in. After all, who doesn't want quick and easy gains? But here's the harsh truth. By the time a stock or investment becomes the talk of the town, the real opportunity for growth has often passed. Why is chasing hot tips dangerous? Well, let's break it down. First, there's FOMO, or fear of missing out. Emotional investing driven by hype can lead to overvalued purchases at the wrong time. Then, there's the lack of due diligence. Following tips without researching the fundamentals is essentially gambling, not investing. And let's not forget speculative bubbles. Remember GameStop and AMC? Many retail investors bought at the peak only to see the value plummet, resulting in significant losses. Real-life examples of chasing hot tips gone wrong are numerous. Take cryptomania, for instance. Many jumped on the Bitcoin or Dogecoin bandwagon at their peaks after hearing promises of instant wealth, only to watch their investments lose half their value, or more. Then there's penny stock fever. The allure of cheap stocks often hides underlying problems, such as weak fundamentals or unprofitable business models. So how can you avoid this mistake? First, develop a strategy. Define your investment goals, risk tolerance, and timeline. Next, do your homework. Research a company's financial health, growth potential, and industry trends before investing. And finally, trust the process. Building wealth isn't about quick wins. It's about consistent, well-informed decisions over time. Are you building your wealth or someone else's? When you chase hot tips, you're often buying into someone else's hype, not your own financial plan. Have you ever followed a hot tip and regretted it? Or maybe it worked out for you. What did you learn? Share your experience in the comments. Let's learn from each other. Mistake number 5. Lack of diversification. Investing all your money in one stock, sector, or even a single asset class is like walking a tightrope without a safety net. Sure, it might feel thrilling if that one investment performs well, but what happens if it doesn't? Let's break it down. Why diversification matters. Imagine you've invested everything in a tech stock, and suddenly that sector faces a downturn due to regulatory changes or global chip shortages. Your entire portfolio could take a hit. Now compare that to a diversified portfolio. While the tech sector might dip, your investments in healthcare, consumer goods, or even real estate could offset those losses. Diversification reduces risk by spreading your money across asset classes like stocks, bonds, REITs, ETFs, or even gold. Industries such as tech, healthcare, finance, energy, etc. Geographies. Don't put all your money in the US or Singapore markets alone. Consider exposure to global markets like Europe or emerging economies. How to diversify smartly. 1. Start with broad-based ETFs or index funds. These give you instant exposure to multiple sectors and regions with a single investment. 2. Think beyond stocks. REITs can provide cash flow, while bonds add stability. Consider alternatives like commodities or cryptocurrencies if they align with your risk tolerance. 3. Check sector weights. Are you too heavy in tech or real estate? Rebalance to prevent overconcentration. Mistake number 6. Unrealistic expectations. Let's face it, who doesn't dream of doubling their money overnight or finding the next big thing that will make them rich in a flash? But here's the reality. Investing is not a get-rich-quick scheme. Expecting unrealistic returns often leads to disappointment, impulsive decisions, and in some cases, big financial losses. Why unrealistic expectations are harmful. 1. Impulsive decisions. Unrealistic goals can make you chase risky investments or sell out of fear when things don't go as expected. 2. Lack of patience. When returns don't materialize quickly, many beginners abandon their plans, missing out on long-term gains. 3. Burnout. Constantly monitoring your portfolio for quick wins can be mentally exhausting and counterproductive. The truth about investing. The stock market historically delivers average annual returns of 7 to 10% over the long term, not 100% in a week. Some years might see incredible gains, but other years could be flat or even negative. What matters is the long-term trend. The power of compounding is what makes wealth grow exponentially, but it requires time and consistency. How to set realistic expectations. 1. Understand historical returns. Research how different asset classes like stocks, bonds, and real estate perform over decades. 2. Focus on the long term. Set goals for 5, 10, or even 20 years down the line instead of expecting quick profits in a few months. 3. Stick to a plan. Trust in your investment strategy and avoid making emotional decisions based on short-term fluctuations. What's your long-term investing goal? Are you aiming for financial independence, early retirement, or simply building a safety net? Drop your thoughts in the comments. I'd love to hear about your journey. Remember, wealth building is a marathon, not a sprint. Slow and steady not only wins the race but also keeps you in the game for the long haul. Now, let me share 2 inspiring stories. First, from the U.S. Lisa was terrified of investing, so she left her money in a savings account for years. After realizing inflation was eating away at her funds, she decided to start small with ETFs. She avoided market timing, stayed consistent, and today her portfolio is growing steadily toward her retirement goals. And in Singapore, Marcus and his wife made the classic mistake of being over-leveraged on property. When interest rates rose, they struggled with cash flow. They restructured, sold their property, and shifted focus to dividend-paying stocks and REITs. Today, they're building positive cash flow and financial security. Now it's your turn. What's the biggest investing mistake you've made or worry about making? Share your story in the comments below. Let's learn from each other. If you found this video helpful, give it a thumbs up, hit subscribe to Wealth for You, and share it with someone who's just starting their investing journey. Remember, investing isn't about perfection, it's about progress. With the right mindset, every mistake becomes a lesson, and every lesson takes you closer to your financial goals. You've got this, and we're here to help every step of the way. See you in the next video.